The stock market is on pace for its worst week since early October of 2008.
It's the biggest one-day drop on the S&P 500.
The biggest drop we've seen since that crash in 1987.
It's the end of the world as we know it. It's the end of the world as we know it. And I feel fine.
Hi everyone, I'm Gabby.
And I'm Jay.
And this is our journey to early retirement. This is a new channel where we are sharing our experience as we get ready to retire in 6 years or so, even with a pandemic happening as we try to save. If you want to hear more details about our plan, check out our introduction video.
Today we want to share with you how, despite the media calling this the end of the world, or at least the market as we know it, we feel fine. It's really tough right now, for some people much more than others, and we know everyone is at a different place with everything going on, and many of you don't even have the headspace to think about retirement. So this is not going to be about how much you should be saving or how much you need in the long run. Everyone's priorities are different, and we're all just trying to make it through this madness together.
This video is about why you shouldn't freak out about any investments you might already have in the market, retirement or regular investment accounts. So, what's everyone saying? Oh, the market is crashing. This is another Great Depression. Well, ups and downs in the market are completely normal. Up until this mess, we'd had a great decade where everything had gone up way more than down.
Yeah, the market's going down now, and it looks scary. But let's remember what happened in 2008 with the housing crisis, which saw the Dow Jones lose close to 60% of its value from October 2007 to February of 2009. It's not even a year and a half. Everyone predicted then that was going to be the end of things. Or before that, when from 95 to 99, the Dow Jones grew almost 200%, then dropped 33% in the fall of 2002. That was known as the dot-com crash.
We can keep going back in history and finding the same cycle that repeats itself. The 70s energy crisis, 1929, and the Great Depression. The point is, the market is cyclical. It has ups and downs. The problem is, you can't know when it will go up or down, but you know it will. This gives you the power to plan for it and ensure you're ready to weather the storm whenever it happens.
So there's an old saying, time in the market beats timing the market. That's one of the keys to our plan. What does it mean though? Well, knowing that you can't predict when the market will go down or when it will go up makes trying to time it not a good strategy. But historically, the market's gone up. And this means that long term is the way you win the market. You get your money in the game and leave it there the right way. But we'll get to that in a minute.
Let's use a concrete example. Imagine it's the beginning of 2008 and we invest $10,000 in the US stock market. That same year and the following, during the housing crash, our $10,000 will drop 49%. Yikes! However, by 2013, just 5 years later, we will not only have made it all back, but our initial investment will have gained 48%.
Yes, right now the market's down some. That's true, right? We had oil go into negative values, and the coronavirus has really affected the way we all live. But from January to December of 2019, just last year, the market was up 31%. And although since the beginning of this year, everything seems awful and we've had some truly bad days, on the whole, the market's only down 10% since this January. The market's doing better than ever. Remember those $10,000 we invested in 2008? Well, if we had put them in the market in 1972 and did nothing else with it, it'd be worth $27,000 in 92, $83,000 in 2012, and $147,000 today, adjusted for inflation. Time is the key.
Absolutely. That's why our plan is to be in it for the long haul. So even with everything that's happening now, we are not changing our plan. We will not be taking any actions. Well, except for one thing. We've heard several people refer to this as the market being on sale. It's 10% off, and after all, who doesn't love a good sale? We see how the market has behaved historically. We see it's all upside. Sure, there are drops there, but as a whole, it's all up. We cannot predict the future, but if the past is any indicator, this is an opportunity.
But how do we go about investing in the market? That's actually another key to our plan. We don't own any individual stocks except a few grants from my old company and my grants from my new company. But why is that? Well, remember how trying to time the market's not a good strategy? Unless you got in at just the right time on basically a lucky guess, you have very little chances of picking a single company or group of companies or an industry that's going to perform the way you want. For instance, if you had put all your money into pharma, you're doing very well right now. But if you had put all your money in oil and gas, you're taking a beating. It's just luck. But don't go switching out your investments yet. This is so important. Now is not the time to sell unless you're in dire straits. Regardless of how your money's invested, you only lose if or when you sell. Remember, time in the market beats timing the market. It will go back up.
So what are we doing? Well, for our money, we invest in total market index funds. Index funds are a type of mutual fund. A mutual fund is a grouping of companies. There are mutual funds that focus on technology and others that focus on communications. Maybe another that focuses, let's say, on a region, for example, Canada. Basically, if you can think of a way to group a set of companies, there's probably a mutual fund for it.
And then there are total market funds. They own shares in every single publicly traded company. That's where we put our money. That way, no matter who's up, we're all winning. So tech is up and shipping is down? Great, we're making money. Shipping's down but farming's up? We're still making money. All of the investment companies like Merrill Lynch, Schwab, Fidelity, and Vanguard, they each have their own total market fund. We use Vanguard because they have incredibly low fees and every Vanguard member is an owner of the company, so the things that are good for the company are good for you, and vice versa.
We specifically invest in the fund VTSAX, Vanguard Total Stock Market Fund. Why? Well, if we had invested our $10,000 to buy 167 shares of this index fund when it was created in 1992, today our shares would be worth $122,000. We would also have made an extra $2,800 in dividends. So, from $10,000 to $125,000 in 28 years, assuming you didn't put a single penny more into it. That's the power of the market.
But we're not financial advisors. We are talking from our experience and sharing one of our strategies in our plan as we get ready to retire in the next 6 years. In summary, despite people calling this the end of the market as we know it, we're feeling fine because we know the market is cyclical, so leave your investments alone. If history has taught us anything, it's that the market will recover. We haven't lost any money until we sell.
We also know that now is a good time to invest in the market, if possible. And if we're going to do so, total market funds are the way to go because they reduce the risk by not focusing on a single company or industry.
So we've included some great articles linked below. We'll do other videos about what type of investment accounts there are, how do you know how much you need to retire, and how do you make your money go further, and many, many more.
We'd also love to hear from you. Do you have any questions? Are you feeling fine? Do you have a similar plan or are you using a different strategy? Call us out if we've made any egregious math errors.
Yeah, I don't think we did, but we were staring at numbers all day and we totally could have. Also, these numbers are only accurate as of the time of this filming. So please let us know in the comments below. Follow us on social media or our blog at GabbyandJaysJourney.com. The next video is going to tackle the seemingly complex issue of geographic arbitrage and how we're going to use that strategy to make our savings go much further during retirement. Please like the video, subscribe to our channel, hit the bell to be notified when we post new content.
Until then, please stay safe, do your part, take care of one another, and thank you for joining us.